Depending on the day or even the hour that you're speaking to someone, either everything is uninvestable or it's time for bargain hunting, or you can selectively look at companies with strong cash flow and fundamentals, or you just hold all cash, right? So what is your approach at the minute?
So I wouldn't hold all cash. I think it does make sense to be invested. And I think what many investors are thinking about today is rebalancing, which is selling the investments that have preserved their value the best, Treasury bonds, and putting it to work in everything that is sold off, which is, well, just about everything else: investment-grade corporates, municipal bonds, and of course, stocks. People are really eager to do this because over the past 11 years, every time there's been a dip, it has paid to buy it. This dip is different, and I don't think it pays to buy this dip yet. So why is there this conditional on it? At some point, the valuations will get more compelling. It's possible the valuations are actually compelling today, but all we know today is price. We know how far prices have fallen. We don't know how far fundamentals have fallen. And we don't know yet what policymakers are doing to arrest this drop. So let me give you a little bit more color on that. Central banks have done a lot to prevent a crisis in the real economy from becoming a crisis in the financial economy. But we have not yet seen fiscal policy step in a significant and meaningful way. Because this is a crisis in the real economy, fiscal policy is going to be one of the prerequisites for my yet, which is, when can you start to rebalance? When you start to see fiscal policy developing, when you start to see it get passed, and when you start to understand how it might impact this real economic crisis.
What does visibility that would encourage you to be more confident to take a risk at the moment look like in terms of the public health response, for example?
So visibility is not perfection. You can't wait until you have near certainty about the future to invest, because by then all the profits have been taken. But you need to have some basis for rebalancing today. I'd say there's a couple of potential sources of that basis. I've already mentioned one: progress on fiscal policy, some meaningful moves that governments around the world are making to try to stop this crisis from becoming a depression. What else? Well, this crisis is ultimately caused by the coronavirus, by a disease that's spreading around the world. Another form of progress, another form of visibility will be for us to see a plateauing and a peaking of new cases in hotspots currently in Europe and the United States. Not seeing that yet. We're seeing an acceleration rather than a deceleration in both of those locations at the moment.
There really isn't much consensus on what will happen next because visibility is just so low right now. But at least consensus seems to be on the fact that we are most likely headed into a global recession. How do you trade that?
I wouldn't even call it most likely anymore. It is a near certainty, and it will almost with near certainty be one of the worst recessions in peacetime. This is less like a traditional economic event and much more like a natural disaster, except the difference with a natural disaster is it impacts one region at a time. When a hurricane hits a part of the southeast U.S., it can shut down a city for weeks at a time. It can take a very long time to recover. This is not one city. This is the entirety of the developed world shutting down for a period of time and really suffering from that. Now, why is this different, and what can you do to get some confidence? It's different because it affects both the supply side and the demand side of the economy. Right now, like myself, a lot of consumers are not going to work. I'm able to still work from home because I work in a service industry that allows me to connect to my office online. But many workers work in retail. They're not currently collecting a paycheck. That makes them very pessimistic. Progress on fiscal policy will be incredibly important. And let me give you an important example of that progress. So all developed countries in the world have an unemployment insurance scheme. Most unemployment insurance schemes require that workers be actively looking for work to be able to collect that unemployment check. That is at odds with the goals of coronavirus containment. We don't want people hitting the payment. We don't want them walking around to employers, potentially spreading the virus. We want to pay them to stay home. Governments need to come around to that. They need to understand that. They need to update policy. One meaningful piece of progress that we've had in the U.S. is, for the first time really in modern history, major parts of the U.S. government are floating the idea of sick pay, as in paying workers while they're sick to stay home. That's unique. That's the first time we've discussed it in the U.S. and it's meaningful progress. But it's only talk. We need to see us getting closer to action.
So what happens when, because of all of this uncertainty, we really are not seeing traditional safe havens like the Japanese yen and gold behave as havens? How do you hedge then?
So I believe that U.S. Treasuries continue to be a very good safe haven asset. I recognize the past week has been a tough environment for long Treasuries, partially because their safe haven status is interacting in unique ways with some of the fiscal stimulus that has been floated as an idea but hasn't been acted on just yet. I believe that in a world where deflation is a big risk, where the economy is likely to contract by the largest amount in modern history, Treasuries still present a good hedge. They're just not going to earn you much money. It is a safe place to park your assets, and it is a safe place to rebalance out of when you have more visibility on the future.